Welcome in. Picture this. It's Friday night. Your restaurant is packed, every table full, the kitchen firing on all cylinders. But hidden beneath all that success, money is bleeding out through invisible cracks. You're making sales, sure, but are you making profit? Most restaurant owners can't answer that question with confidence, and that's exactly why 60% of restaurants don't survive past 3 years. The culprit isn't bad food or poor service, it's financial blindness. Today, we're cracking open the true financial operating system behind every profitable restaurant, the chart of accounts, or COA. At first, it sounds like a boring bookkeeping list, but in a restaurant, it is far more than that. It is the master blueprint behind every profit and loss statement, every food cost report, every payroll analysis, every cash forecast, every tax filing, and every management dashboard. Every burger sold, every bottle poured, every vendor invoice, every payroll run, every gift card redeemed, and every delivery fee eventually lands somewhere in the chart of accounts. And here is the big idea we will follow from start to finish. When those accounts are designed well, owners can see exactly where margin is earned, where it leaks, and what to fix next. So let's begin with the real question. Why can one restaurant see its problems clearly while another only notices them after the profits have already disappeared? Here is the brutal truth that keeps restaurant owners up at night. You can have a full house every single service and still be bleeding money. Why? Because traditional accounting treats restaurants like any other small business, but restaurants are financial ecosystems unlike any other. Think about it. You're juggling food costs that change daily, labor that fluctuates by the hour, delivery platforms that take mystery fees, inventory that spoils, tips that need compliance tracking, and sales tax regulations that vary by state. Here is the core problem. Restaurants run on razor-thin margins, so blurry financial data is genuinely expensive. A small coding mistake can hide a massive operational problem. If food purchases, beverage waste, discounts, merchant fees, delivery commissions, and labor are all dumped into broad buckets, the owner can see that profit fell, but not why it fell. Was it beef prices? Poor portion control? Overtime? Third-party delivery fees eating into margin? Unreconciled card deposits? Or was sales tax accidentally treated like revenue, inflating the numbers? A strong restaurant chart of accounts turns daily activity into clear, actionable financial signals. Each account should answer a specific operating question. Can we trust our food cost? Are beverage margins slipping? Is labor rising because of scheduling decisions or overtime creep? Are gift cards and sales taxes being handled correctly? Once we understand why visibility matters this deeply, the next challenge becomes obvious. So why do so many restaurant accounting systems still fail to deliver it? Now comes the gap that destroys restaurants quietly and invisibly. Many restaurants don't fail because they have no accounting system. They fail because the system is either too vague, too bloated, or dangerously disconnected from daily operations. When food purchases, beverage waste, volatile discounts, and messy labor fees are grouped too broadly under vague categories, managers simply cannot see what went wrong. If your chart of accounts resembles a bloated, undifferentiated list, those critical margin leaks stay permanently hidden in the shadows. One restaurant may lump all food and beverage costs together, erasing menu margin levers. Another creates hundreds of accounts, making daily coding harder and month-end close slower. A multi-location group duplicates entire account trees for every store instead of using location dimensions, turning consolidated reporting into a tangled mess. And then the system integrations add another dangerous layer. Your POS system churns out sales data, your inventory platform tracks ingredients, your payroll service calculates wages, and your bank feeds transaction data, but none of them speak the same language. Without clearing accounts, card deposits, processing fees, chargebacks, and settlement timing differences get mixed together into an unreconcilable swamp. Without proper liability accounts, sales tax and gift cards can quietly inflate revenue. So the missing piece is not simply more data. It is a disciplined structure that forces every system to speak the same financial language. And that structure starts with completely reimagining your chart of accounts as a profit navigation system, not just a tax compliance checklist. So how do you actually build a chart of accounts that works for a restaurant? It starts with a deceptively simple principle. account for what it is, then tag where it happened. First, you need a predictable numbering system that leaves room to grow. Assets live in the 1000s, liabilities in the 2000s, equity in the 3000s, revenue in the 4000s, and your COGS and expenses start at 5000 and go up from there. But here's where the real power lives. Under food COGS, you don't just have one big bucket. Depending on your scale, you have sub-accounts for meat, seafood, produce, dairy, dry goods, and paper goods. Under labor, you separate front-of-house hourly, back-of-house hourly, management salaries, payroll taxes, and benefits. Use clear, consistent names so reports sort correctly and staff don't accidentally create duplicates. And this is the granularity rule that separates good COAs from great ones. Create separate accounts only where your team will actually take action on the data. A single location cafe may need just one food COGS account. A growing multi-unit group needs that detailed breakout to spot problems fast. Then you layer on dimensions. Use location tags for each restaurant, class tracking for departments like catering or events, and project codes for pop-ups and special operations. This means you can have one standardized food sales account that reports consolidated across all locations and instantly drills down to a single store without duplicating your entire account structure. With this blueprint in place, the next step is mapping every one of your daily operating systems directly into it. Here is where everything changes. The chart of accounts becomes truly powerful only when every operating system maps into it consistently and automatically. Your POS categories should post food, beer, wine, liquor, catering, delivery channel sales, discounts, voids, sales tax, tips, service charges, and gift cards, each to the right accounts. And this is critical. Sales tax goes to a liability account, not revenue. Gift cards go to a deferred liability until the moment of redemption. Credit card payouts and third-party delivery settlements must pass through clearing accounts first. So sales, platform fees, chargebacks, and timing differences can be properly reconciled rather than guessed at. Inventory should post vendor invoices to an inventory asset account first, then relieve them into COGS through actual counts and usage tracking. That single discipline lets operators compare theoretical food cost based on your recipes against actual food cost based on real inventory counts. When your seafood cost spikes by 2%, you don't wait until month end to discover it. You see it within days, trace it to the exact invoice, and call your supplier before you've lost thousands. Payroll should cleanly separate front-of-house hourly, back-of-house hourly, management salaries, payroll taxes, benefits, and tip pooling into distinct accounts. Once that mapping is clean, your KPIs become genuinely trustworthy. COGS percent, food cost percent, beverage cost percent, labor percent, prime cost, gross margin, contribution margin, RevPASH, and EBITDA. But the story doesn't stop at better formulas. The real payoff is better operating control at every level of the business. The implications of a clean chart of accounts are both immediate and far-reaching. Let's start with operational intelligence. Instead of waiting for a vague month-end report, owners can now see location-level profit and loss statements in near real time. Compare catering profitability against dine-in, evaluate delivery channel economics, monitor commissary production costs, and allocate shared overhead using consistent, documented rules. Classes, locations, and tags add rich operating context without ever bloating the account list itself. But the power goes beyond reporting. A well-structured COA powers exception alerts that act as an early warning system. Your dashboard shouldn't just show trend lines. It should proactively warn the team when food cost spikes abnormally, inventory adjustments turn negative, overtime climbs past thresholds, discount patterns look unusual, or merchant deposits fail to reconcile against expected settlements. For multi-location groups, this is genuinely revolutionary. You can compare location-level economics using identical account structures, instantly spotting which manager is controlling labor and which store has a developing waste problem. And then there is compliance, the area where the stakes are highest. Sales tax payable must tie directly to jurisdiction-level filings. Tip reporting and payroll tax deposits must follow employer obligations under IRS guidelines. Gift cards must remain contract liabilities until redemption, with breakage recognized under proper revenue recognition standards. Depreciation schedules need documentation, and alcohol-related taxes and fees require clean audit trails. In an industry where margins are measured in single digits, this level of control doesn't just improve profits, it determines who survives and who becomes another statistic. All right, so you're convinced. Your chart of accounts needs an overhaul. But how do you actually execute this without disrupting the business midstream? The answer is to treat a restaurant COA redesign as a controlled system change, not a quick account renaming exercise. Here is your proven implementation roadmap. Days 1 through 30, stabilize the structure. Gather your financial team, document reporting pain points, interview stakeholders, and review your current account list for duplicates, inconsistent names, and miscellaneous buckets that hide real data. Design your new numbering scheme, write your naming convention rules, and lock the gate. No more ad hoc account creation from this point forward. Days 31 through 60, map your systems. This is the most critical phase. Configure your POS, payroll, inventory, and banking platforms to post transactions to the correct accounts in your new COA. Test everything rigorously. Run a week of sample transactions. Verify that clearing accounts zero out. Confirm that sales tax posts to liability and not revenue, and validate that gift card redemptions relieve the deferred liability correctly. Days 61 through 90, launch and govern. Turn on your KPI dashboards, conduct manager training on the new coding standards, complete your first full monthly close using the new structure, and schedule quarterly COA reviews. Role clarity throughout this process is absolutely essential. The owner sets reporting priorities. The general manager validates operational categories. The controller owns governance and the close cadence. The bookkeeper handles daily coding and reconciliations. The external CPA confirms tax and accounting treatment. The payroll provider maps earnings and deduction codes, and the systems integrator builds the POS to GL automation rules. Follow this roadmap with discipline, and by day 90, you will have transformed from financial chaos into genuine profit visibility. Let's close the loop. We started with a restaurant owner flying blind, money leaking through invisible cracks, decisions made on gut feelings, and financial reports arriving 6 weeks late and probably wrong. That is the reality for most restaurants today, and it is a primary reason so many fail. But here is what we have learned together. A properly designed chart of accounts is not just an accounting upgrade. It is a complete business transformation. It turns overwhelming daily complexity into clear, actionable intelligence. It changes your monthly close from a 4-week nightmare into a 4-day routine. It gives you the confidence to expand, the insight to optimize labor and food costs, and the control to protect your margins before problems become catastrophes. An optimized chart of accounts is not about having the longest or most complex list of categories. It is about commanding a lean, trusted source of truth that definitively answers the right operating questions every single month. So here is your call to action. This week, open your current profit and loss statement and ask one honest question about every single account. Does this account help me answer a real operating question? If the answer is no, that is exactly where your next margin improvement begins. Build the structure, map every system carefully, use locations and classes wisely, reconcile your clearing accounts religiously, train your team, and review your chart of accounts every quarter as the business grows and changes. When you transform your numbers from a mess into a system, you do not just improve your accounting, you transform your entire restaurant business. The tools are available, the methodology is proven, and the competitive advantage is waiting for you to claim it. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.